Okay. Very good discussion by the C-level ladies. Very insightful, and hope you all enjoyed it. All right, we're going to our final presentation this morning, and it's regarding mergers and acquisitions. We're fortunate to have a longtime supporter of South Wireless Summit, let alone the industry, and he will be moderating this with, I think, 3 or 4 other folks, and that gentleman's name is Clayton Funk. Clayton is the founder and CEO of Signal Strength Advisors and previously served as the managing director at Houlihan Lokey after its acquisition of MVP Capital. He has led more than 200 transactions totaling over $5 billion across technology, media, and telecom sectors. His work includes advising private equity-backed tower companies, wireless carriers, broadcasters, and infrastructure developers. He frequently speaks at industry conferences, and he graduated cum laude from Washburn University, enjoys traveling, golf, and time with his family. So please, let's welcome Clayton Funk.
They're busy micing me up back there.
Clayton, we're on a time schedule here. Let's go. Move.
We're hustling. We're hustling. Just waiting to get mic'd up back there. I know. How you doing? Great. Well, Craig, thanks for the introduction. Always really appreciate the opportunity to come and facilitate a panel, speak here at South Wireless Summit. This panel is going to be no exception, being able to work with some outstanding folks and being able to have them offer you their perspective on the M&A market. I will have them introduce themselves, and if they left something out, then I'll go ahead and add something as to why I asked each of them to participate, other than because we like hearing their perspectives and opinions. So with that, Brenton, start with you.
Thanks, Clayton, and thanks to the South Summit. My name is Brenton Atcheson, SVP of Corporate Development for Everest Infrastructure. Everest is a tower investor focused on aggregating towers, rooftop, and ground lease assets. I work on the integration, sourcing, and closing of those transactions, and then also tracking those assets as they enter our portfolio.
Can you guys hear me? Great. Clayton, thanks for inviting me, and I'm glad to be back at the South Wireless Summit. Always a great event. Jason Nicolay, Fifth Third Security, Managing Director and Head of Digital Infrastructure. So anything that is towers, wireless, broadband, data centers, or touching the wireless space is where I'm spending time raising capital or doing M&A transactions.
Hey, good afternoon. Actually, it's still morning, isn't it? Good morning. Scott Riggs with Everlink Capital, and pretty much what Brenton does is exactly what I do, but we got a team here in Nashville, and we're building a portfolio, and we source and integrate the deals as we get them.
Great. Yeah, in part of asking the gentleman to participate, both Brenton and Scott are very active in acquiring towers, but they've also been sellers, so they'll be able to offer that perspective at different points in the conversation here. And then Jason, being a banker, not only covers, as he said, the tower space and in building, which of course is important to a lot of folks in the room here, but for those who touch fiber, data centers, everything else under this umbrella with digital infrastructure, being able to have your opinion and perspective too would be helpful. Let's just dive right in a high-level overview of the M&A market. For those who have either followed this as a owner of assets, potential acquirer of assets, or have been to enough conferences to kind of hear what's going on, it seemed like a bit of a broken record, I would say probably the last several years, where you've got a big supply-demand imbalance between more people with money looking to buy towers, it seems like, than there are people to buy towers. Everest just announced another $500 million equity commitment from their sponsor, Peppertree Capital, and then Peppertree announced a $1 billion commitment, right, to Bernard Borghi for his efforts to acquire towers. So there's just more and more people looking to acquire assets. Would love to have your guys' different perspectives on how you're seeing the M&A market, and start with Scott.
Well, this is going to be a short answer. I think people are paying too darn much.
Unless you're selling.
And you're driving the price up. No, I'm just kidding. You're doing a good job. I do think there's an imbalance right now as far as the value of these towers right now. And these portfolios are trading back when you had US Cell, Dish, and the carriers as potential tenants. So I feel like we're seeing now where some new entrants, and I mean by new capital coming into the market, that they're starting to still pay those high rates for these deals that are on the market. And I feel like we're not in the business, like my capital partners want more than a single digit return. And I feel like that's where the market is right now. What I'm seeing on the market, it's really, really hard to buy them. So we're really focused on the development side.
Sure. Yeah, we're very active in the acquisition space, but we're very selective. We like to find opportunities that fit within the mix of our current portfolio and how that blends together. And that can mean from geography to tenant types to tower types across the board. So we look at it on a holistic approach. But to your point, it's very active, and their prices are very high. And some of the deals make a lot of sense, and some of them you scratch your head on. So.
Yeah, no, look, I agree with both of them on the tower space for sure. It's definitely remained as one of the most robust M&A market spaces of all of digital infrastructure. What's interesting is the landscape has changed a lot in the space overall from digital infrastructure. Towers continue to have the benefit of sticky contracts, credit quality tenants in the big three carriers at this point. Obviously, there's less to go around for new development, but as investors are looking for other opportunities, spaces like broadband have started to dry out a little bit in terms of some of the returns and opportunity for growth. Obviously, everybody's talking about data centers and the mega deals that are going on in that space, but the stability of towers is definitely proved the M&A market to be resilient in that space. And one thing I just note is, I was actually talking with some of my ABS team earlier today, and the tower space and the M&A in the investment space in terms of digital infrastructure has remained much more stable in the credit markets, which is obviously driving a lot of the valuations here in comparison to a lot of the other spaces, given the conflicts in Iran and other places and the uncertainty and turmoil in the world right now.
Yeah, I think kind of echoing from what Jason had said, I mentioned towers and buildings sits within this broader digital infrastructure umbrella, and towers is viewed as really the safe haven. And so what Scott had said, where people are they're settling for single-digit returns on acquiring assets, whereas they wouldn't maybe make that same bet on something that's a little more unstable, like, say, fiber, or just given even the data centers, while it's really hot right now, these are called hyperscale deals where it's billions upon billions of dollars. It's not a lower to middle market sort of deal like towers are. So I think in one way, it's a vote of confidence in the tower space. Towers are stable. It's got a 30-year plus track record now of public companies, or probably more technically 29 years. You have had obviously some hiccups, including recently, of course, Dish, and of course, obviously US Cellular leaving the market too and getting acquired. But despite all that, there are definitely a lot of these same investors that float around digital infrastructure. They will tell you, I only want mid-double-digit returns, or they'll say, hey, look, this is what I'm targeting. But then they'll caveat it to say, yeah, but if I find the right tower deal, I will drop it to here. Or they'll even say, my minimum deal to buy something is $200 million, but they'll go down to 100 million because there's just not many opportunities. So I think that's a big vote of confidence in the space and the resiliency. I know it's tough, Scott. We've talked about how competitive it is to buy, but in the big picture, I think that's a very positive thing, I think, for the space. Brenton, go back to you. We'll lead off on the next one. What are the types of deals that you're seeing out there, types of sellers, that type of thing? And, obviously then Scott would love for your perspective on it. And then Jason, whether you want to opine about towers, but also the other spaces would be great too.
Yeah, I think as we think about it, it's a bit of a Venn diagram. So you have the institutional holders of towers that are meant to be tower holders, and they're expected to sell those over a certain minimum life cycle, 3 to 5 years. You've got the institutional holders of non-core assets. So these are large companies that own towers. That's very non-core to their business. They have them from legacy utility needs, whether it be pipeline, gas infrastructure, things like that. And then you have the owners that are small family-owned businesses, right? And each of those have a different flavor of how you approach them in a transaction and what they're prepared for and not prepared for. The institutional owners, clean transactions. They know what a tower deal looks like from a contractual basis. Those are pretty quick, but they're also really competitive, to your point, because they're clean transactions. On the non-core owners, these are typically assets held in large companies. These are an afterthought to them. They want speed to close, efficiency, and then no disruption with their core business. We've done a number of those transactions, and I think that Everest is pretty specialized in that piece of it, whether it be power assets, pipeline assets. They don't want you to touch their infrastructure. They want to monetize the asset quickly and have a relationship on a go-forward basis. And then on the independent sellers, it's really about building that relationship and teaching them and walking them through that process. Even if that helps them increase their nominal value, they want to have a trusted partner because there's a lot of emotional ties to these assets. They've been operating them for 20, 30 years. And so having that relationship, walking through the process, even if it ends up costing you a little bit more, bodes for a long way and a good relationship with the seller.
Yes, Scott, how do you see it?
Yeah, we see the same thing. I think the mom and pops are probably the hardest to, go through a transaction. They don't really know a 27-page PSA. They freak out when they see language and indemnification, and so you got to educate them. It takes a little more time, and just like Brenton said, that their paperwork is not in order. They don't even know where their leases are. They don't know where the NEPA is. They can't find, the ground lease for, we
can't find that handshake lease.
Handshake lease. And then, we're trying to help them educate. And also, we want the deal, so we try to work on them and try to help it. But we see the institutional, when you see one of those, they're pretty well together and they understand. They've already built the data room. It's already ready before you even get to it. Like, Clayton, when you guys introduce a deal, usually you already have the data room ready, before you even give us the information. So that's comforting. But, there are all types of deals, and I think we do a pretty good job too, is, trying to put the paperwork back in the cabinet and try to figure out, how to make the deal, make it clean. We like clean deals, and we try to get to that point. So I think the same as Brenton said.
I guess the only thing I'm adding to that is I think you guys put a nice advertisement out for Clayton and myself on why you should hire advisors to make sure all your documentation's cleaned up and ready to go and presented in a way that's
and I did forget you. I'm sorry. I did not mean to leave you out. You guys do a good job too.
But look, I think that's the biggest thing, as you noted, the institutional buyers or sellers in that case, they've spent, and many of you guys are in the room, have spent, years and decades perfecting this process and making it very easy to transact. The major corporations, obviously, sometimes it just takes a long time, right? Getting inside of a large organization, those assets can be coveted if you get them, but there's usually not a lot of movement in those deals. They have their sticking points because, as you said, right, if you work with the railroad, there's only one task: make sure the trains run on time. And then, the small mom and pop folks that are continuing to build towers and are obviously, I think, very important to the space as a whole, getting things done in local jurisdictions where, frankly, that local touch is super important. Being able to help them and document stuff and get them teed up for the first time they run a process and give them the guidance and the support is helpful, I think, for everybody in the room as a whole.
Yeah, offering perspectives really on couple of the three different categories we talked about. One with clarification: institutional is your private equity backed. These are, again, companies that have built portfolios organically, acquired them, and their whole plan is to, I think maybe Brent, you said it, they're out in 3 to 7 years, maybe 10 years. The non-core assets ones, that's where you can really, for some folks in the room here, maybe not tower owners, but you're a vendor helping people get their files in order and the like. There's a transaction on the market now that I may be familiar with, where they haven't tracked down some ground leases. And so it's going to be the buyer's responsibility to help track down those ground leases. And these towers have been in existence for 15, 20 years. We know it exists out there. It doesn't happen to be in the shoebox that the tower owner has kept their files. So there are still companies out there, despite this industry being, say, 30-ish years old and very institutional in terms of financings and what's required when you're buying and selling an asset. Until you get to that point, there's some people who are still flying by the seat of their pants because they haven't needed some of these different records. And the last piece, too, I talk about, the mom and pop category. This is a space, I know when I started my career about 29 years ago, really worked with a lot of folks. And I remember over time, some of these owners are saying, okay, I'm making all this money, and they can get a lump sum of money, but what else am I going to do with the money? And it's a great problem to have for some of these folks. And so some of them have not sold, and so they continue to hold on. What we're starting to see is maybe some life events happen in that space. And it's a quote unquote great problem to have when you finally get to a point you've held these assets for 25, 30 years, and then you're getting offers in the door that is generational changing wealth. So I know you guys see that as buyers as well. And those are some fun transactions. They can be a little difficult, but you're putting money in people's pockets that they've worked hard and long for over the years. And that's pretty cool to see. It's rewarding. Jason, we'll start with you. When you work with a seller, and whether you're talking to them or potential seller, you're selling in 3 months or they're selling in 3 years. What would you say are the top 3 things that a seller should be doing now, preparing their business for sale?
Yeah, and in different orders, I guess, and maybe no particular order, documentation is the number one thing I can recommend. Just like you're doing your taxes, have a file for everything, whether that's the ground lease, the tenant lease, the NEPAs, the phase ones, anything that you can do to substantiate the quality of the asset, the value that you put in is going to be super important for that. 2, I'm gonna put a plug in for the attorneys in the room. Hire a good counsel, someone that understands the space that you're doing, understands how they can add value for you, give you the protections that you need in a transaction. Develop those relationships early. It's valuable as you think about building your business and putting the agreements in place that you have today and that you want to sell in the future. And then lastly, I do find value in advisors. Obviously, that's a bit of a self-plug for all of us in doing that in this room, but I think that they can provide an immense amount of value of what's going on in the market, so you know the right time to sell. The markets will always have fluctuations, but I think being able to understand if the right time, if the credit markets are going down and debt prices are increasing, that's obviously going to put an impact on valuations. And if you're not living and breathing out on a daily basis, you may not know the right time to go to market.
I can go next. I would say, and I'm not plugging these two right here, but advisors are really important. Just like Jason said, that they can set the expectations of a transaction, and also the paperwork, getting those files back in the file cabinet, and kind of setting the transaction and also setting them up so, there's not all these surprises that, hey, where's that NEPA? Where's the phase one? Where's this? And you guys can educate the seller. I think that is super, super important. And I 100% agree with the council. The council is one of the long poles in the tent every time for us, because they'll hire, nothing against if you're a real estate attorney, but they'll hire a real estate attorney, but it's different than a telecom attorney, and they just really look at it a lot differently. Although they may be selling the piece of real estate, that's fine, but it's not really a real estate transaction. So I think that's really, really important. Those 2 things are important. Of course, all the documents are very, very important.
Yeah, my 3 would be, number 1, know your TCF. This business on the tower space is valued off a multiple of TCF. You need to know what it is. If you're a mom and pop, delineate between your personal expenses you might be running through the tower sites and what truly is site level TCF to maximize your value. And then have a conversation, like you said, with the advisors. For number 2 is understand what mechanics you have and levers to pull to increase your TCF, whether that be know your tenant mix, who you're trying to attract, know what your ground leases say, what the durations are. All of those are factors into valuation, and a quick conversation with any of the brokers can kind of lead you that and position you in the right way. And then the 3rd, documentation. Really focusing on, if you want to have a speedy transaction with not a lot of hiccups and diligence, having that ready to deliver to the buyer at a moment's notice is very helpful.
Yeah, and appreciate all that feedback and agree with all of it. One thing I would add as well is pay attention to what has been put into your tenant leases that you may not know has been put into your tenant leases. And I just think read it carefully, and I'll give just a very high-level example. When this business started, the tenant leases were equipment-specific. And that was how amendment revenue was created. As there was an XG or an upgrade, there was a more amendment revenue to the tower owner. And now there's been a swing where there's been increasingly envelope loading, unlimited loading, or whatever for, say, the anchor tenant. And those are two very different ways to interpret the value of a tower and a value of, say, a Verizon lease, AT&T, or T-Mobile lease. So I know a common question we like to ask our clients is, do you have bucket loading, envelope loading, or do you have equipment specific? And sometimes, the tower owner will say, well, hey, I think it's one way, and then you get into the leases and there's been an amendment where the carrier has put some different language in the amendment, the tower owner didn't look at it closely, and therefore the terms have changed. So that can be a surprise that you can try to eliminate early on just by digging into what you've signed or what the carriers have tried to have you sign as well.
AI is a good tool for that. If you run it through AI, you can do a summary, and it's actually really good. So.
Yeah, no, and I know there's companies out there who work at a pretty high scale that, you feed the documentation in there and say you have 4 different versions of a lease that go back 20 years. They will spit you out within, I think, minutes to hours, the differences in those documents, right? Yep, that's a good point. Switching to the negative, gloom and doom, there's a cliche-ish question, what keeps you up at night, et cetera. We'll love the panelists to opine on, how they're seeing things, or maybe if they're trying to look around the corner to see what could happen, what are the things, could threaten the tower space, whether it's, values, whether it's, technology, et cetera. We'd love to hear what they're saying. I will preface this with, when you talk about the resiliency of the space, people, I've said it early on, this has been a very similar sort of talk the last few to several years about valuations are high, more people looking to get into the space and there are opportunities to buy, et cetera, et cetera. And if you look back over the last 6-ish years, this space has been able to be incredibly resilient despite, see if I can name them all, global pandemic, for some people, controversial presidential elections in the US, Dish failing, starting failing real fast in that period of time. Obviously US Cellular getting bought, rising interest rates, which in theory was supposed to impact valuations and never did. The public companies, their equities have traded off down, and they've been coming back, but there's been, that which you would think, oh my gosh, that's going to cause some sort of turbulence in the space, and really hasn't. I mean, those are some pretty big negatives that this, and I'm sorry, lastly, and it came up last on the panel, satellites taking over the world. So all those things, and everything has been really, really stable in the private tower M&A market. But we'd love just to hear your opinions when you're sitting either with your investors, or Jason, when you're talking to investors in this space and the like. What are the things that you're hearing out there that people are worried about, monitoring, et cetera, that could ruin the party?
I would say the number one question that I get for non-tower people is, are satellites going to take over? We always hear it, and I think it's fantastic what Starlink is doing. They're providing a service that is not available in tons of areas. So I think it's a great overlay, but it's definitely not going to take over this terrestrial type service that we have. Nothing really keeps me up. Obviously we didn't like Dish going away, and we don't like US Cell going away, but it's still a strong industry, and it's resilient. It's been through all this stuff that he just mentioned. We feel like I feel like there's going to be another entrant sometime down the road here. I just don't know where. We'll see where 6G takes us. I think that's a place that we all don't know right now what those applications are. If you guys remember, not too long ago, 5G, we didn't have Uber, we didn't have Airbnb, we didn't have all that stuff, and now we've got it. And now there's going to be another wave of things happening that we can't account for right now.
I think my biggest thing is the carrier health. I think back to TCF that I said is my number one thing to focus on and understand in your business. It's really, what is the revenue top line? That's coming from your carriers. How are they performing and how are they doing? That's something that I think about often. Dish, US Cellular as examples. Want to make sure that you have good relationships with them. They're in cost reduction efforts, as we all know, across the industry. So how can you leverage being an owner of a tower and helping them perpetuate what they're trying to do from a coverage perspective as a collaboration as opposed to an adversarial relationship? I think that's something that's really important for all of us to work on and focus as we go for the next couple of years.
So I'm going to steal something from Clayton from probably 15 years ago. It's the unknown, right? I think that's the biggest thing that keeps me up at night. I don't think this is a space that has many downside risks, to be honest with you. We've seen a long tail on this that's been positive. Interest rates have fluctuated, valuations have stayed stable. There's been cycles of CapEx spend and down cycles of CapEx spend. There's always another cycle. To your point, 6G is going to come up. I don't know what the technology is that's going to monetize that. There will be something, right? Like I think is at the end of the day, and I can kind of relate back to that as you think about different sectors within overall digital infrastructure. Everybody's nervous about AI right now. I'm not worried about AI too much in this space. You still have hats, hard hats and steel boots that are building these things and making them work. There's still tons of coverage that needs to get done. So even with 3 carriers and not having a 4th or 5th in the space, there's plenty of empty holes there. Capacity uses continue to increase. And I think one of the things that I keep coming back to, and maybe something will change in this, is that kind of uncertainty is, if we go back to the credit crisis back in the 07, 08 area, we were all terrified of what was going to happen with telecom. Is the money going to keep rolling in? The one thing that was really stable is people didn't give up with their cell phones. They gave up landlines, they gave up other functional entertainment options, but they did not give up cell phones. I think that will continue to be true, as it's a device that you can literally go on streets where, the unfortunate people that are homeless and they have cell phones, right? Like legitimately it is every piece of our life is surrounding around this space. And so I think that continues to be good. The question around satellites, look, I think it's complementary. At the end of the day, there's still a lot of physical limitations on what it can do today in terms of even on the low Earth orbit and the LEO constellations that are out there. It's going to continue to be complementary. As a former, I operated for about 4 years, and we had network in Alaska, and I was legitimately concerned about satellite there because it was a fixed wireless solution in a village that had 20 people. I was never going to be able to afford to build fiber 3,000 miles away from where my plant was. That makes a legitimate argument, but to be able to service and do the stuff that we're doing in infills and suburban and urban areas, and even kind of next edge of the rural and suburban communities, that's still going to be best served by towers, wireless, wireline, and the investment in CapEx continues to happen. I think people are continuing to be bullish on the space. The question is how can you build the returns compared to the other digital infrastructure assets that they're investing in? And that's really, I think, what you got to keep looking at, is if there's another investment that becomes more attractive as an investment tool, does valuation come down, or do interest rates go up and drive valuation down?
So you mean something that now causes everybody to want to talk about data centers like AI?
Exactly, and getting 97% of your funding through debt is very concerning.
Yeah, that's crazy. I know a couple things I'd add just to what the panelists had said. The carrier health is something that I continue to get a lot of questions about from the investor side. A lot of the carriers are in cost-saving mode, as a lot of people here in the room know, or have maybe felt that pain with fluctuation of job stabilities, et cetera. The optimistic view is that the carriers will figure out a way to monetize 6G, whatever 6G becomes. And I think that's a pretty important thing for all of us to watch. We've had a great career for those who've been in the space a long time. The carriers didn't really figure out a way, on the, say, 4G or even 5G to monetize it. That went to, on the 4G launch, your Ubers of the world, your Lyfts of the world. They became incredibly profitable, amazing businesses on the backbone of the wireless network. It's not necessarily that the carriers themselves participated in that profitability. I don't think anything's going to be coming out of 5G. We're now further enough into that. There's been no real kind of big, massive thing where the carriers are announcing that they're spiking their revenues, et cetera. So I think, we've got to hold out hope that there's going to be something in the 6G side that the carriers then say, okay, wait a minute, I'm now so flush. I no longer need to be in expense cut mode. I no longer need to be worrying about my margins because I'm now become profitable versus worried about expenses. So that's one hope, and that's, I think, what people are worried about when you really start looking long term. And then, Jason, you mentioned it too. I call it the unknown, and I probably came out of that from that credit crisis and the mortgage crisis, because unless you were providing those mortgages at some outrageous terms that were no longer sustainable, you probably didn't know, like most of us here, that was going on. So, I like to joke, never underestimate Wall Street's ability to convert, their greediness into making money. It may not be long-term sustainable, but by golly, they're going to make money when they can. There could be something going on like that now, and it could come back and sneak up on us, and only in hindsight will we be able to say, oh God, that sucked. That really, really derailed things. Because there's only been 2 real spots in the tower space, at least in my career, that have hurt this space. The tech bubble in that 01, 02, 03 timeframe, you had 2 public company bankruptcies, okay, SpectraSite and Pinnacle. Then the other one was the credit crisis, and that was in that kind of 08, 09 timeframe where you really couldn't borrow money and the terms were egregious. That's it. In 29 years, that's pretty remarkable. But doesn't mean there could be something out there bubbling that we just don't know about yet, right? I'm going to ask one question I didn't put on the preparation, then we'll end with one, then we'll have some time for a Q&A. On the data center AI tie, and for those who haven't followed this, you go to a conference that's not tower related here, you go to digital infrastructure, people are like, yeah, okay, towers are cool, but what about data centers? And it's all about the AI demand and driving that. I get the question, and if you guys get it, what is going to be the impact of AI, if anything you know yet, on the tower space?
I think it puts a more of a load on the digital network, on the wireless network. So like you said a point that 4 and 5G really didn't monetize, right? So it went the other way. It actually put more strain on their network. They're using more data. They have to supply more data. So, I'd actually think it's actually reversed. So I'm with you on the 6G. I bet the carriers figure out a way to monetize that. I think it's a strain. I think it's an actual strain. So something's got to happen. Like, the data centers, they're building these big boxes everywhere. But I think there's such a strain on how are they using it? Not just at your home computer. How many people use their phone for about everything now? There's a lot of people that don't even hardly use their PC very much. So the strain has to come on that wireless network. It just has to. The fiber only runs to a certain point. They run to the bottom of the tower. The tower's got to get the signal. So I feel like that's going to be a point of contention at some point.
Yeah, I completely agree. I think it's not just your phone, it's the birth of wearables, your connected car. It's all of that has to be filtered through a pipeline of wireless, right? None of that can be wired if it's moving around. And we, being the tower owner, we're going to facilitate that for the carriers. And they do need to figure out a way to monetize it to continue to be healthy in the space. But I'm excited about that as the pendulum swings from the AI data center build out to how do we deliver this to the consumer so they can utilize it and grow whatever they're doing in their business or their personal life.
I'm going to take a 2-prong approach to this. I think one is I agree with both of you on the access to fiber and bringing that speed of accessibility to the wireless devices is going to continue to be critical. It's still amazing to me, and I saw this while I was as a fiber operator. The amount of sites that still have a lack of fiber to them is immense. So the extent that, not that you guys make the decision on who those fiber providers are, but you have a ability and path to be able to talk about that, that's really helpful, right? Because at the end of the day, all these data centers are driven by fiber, the connectivity from data center to data center and other connectivity points. So that will be advantageous for them to be able to use, for you guys to be able to use on your personal devices. How towers may be affected, I think, is probably more on the development side of where AI might actually be both complementary and destructive at the same time in terms of employment in the space, which is, hey, you can go hire an AI tool to go do the review of the documentation, as you said. You might be able to use it for site selection and be able to pull out all the things you need on a title before you go send people out there, right? And so you may need fewer and fewer people, which means that you may need fewer and fewer people in this room to go do those functions. But I think at the end of the day, people will still be reviewed. I'm still a big believer that most jobs are still a level of an apprenticeship, so you can't really ask somebody to review something if they've never done the work and understand where the traps are. I think as you think about that and growing your own businesses, be cognizant of what you give AI, and if you don't have a backup resource to be able to validate some of those tools.
So, ending on a positive note, I've asked the panelists to give their, kind of bullish views over the next 12 to 24 months. Some of it, obviously positive stuff on AI from some folks, but kind of go down the road. We'll start with you, Brenton, and Jason, then Scott to wrap up before we have some time for Q&A.
Yeah, I go back to the AI theme. To your point, many of the conferences focus on data center build out. That is the first stage of it. The next stage is how do you deliver it, whether it's fiber or wireless. I think that's the next conversation to be had once those build outs have started and progressed a little bit further. And I'm excited to see how that rolls out. And hopefully some more freedom from the mid-band spectrum, expanding that and supporting the networks is very important. So.
I think my excitement for the space is, I think I heard this maybe at the last year's wireless summit, is kind of the new entrance into the space, meaning the employee base, the leadership that's being taken on as kind of a changing of guard. I think there's, it's a signal that the space is healthy. There's opportunity that's still there. It may not be the same way it was 20 years ago, but I think there's a long-term viability of the space, and I think that's a lot of resilience here, and I think gives a lot of opportunity. I think valuations continue to remain strong. There's not any sort of secular concerns that I see. So I think there's a good positive forward trend, good tailwinds.
So I think, my number one thing would be coverage. I still think, we're really lax in coverage compared to other countries. So I'm excited about that. I'm not excited about losing some of the other carriers, but still, I think there's still something's going to happen. I'm excited about 6G. I think something's going to happen there where the carriers are going to figure out how to monetize. I think that's important because they're going to then in turn put more CapEx towards building out networks, and that the strain on the networks right now is still there. It's real. And like you said, Jason, if you don't have fiber to the tower right now, I was in the fiber business before, but if you don't have fiber to the tower and you're using microwave, it's an option, but not a great option. I would suggest trying to figure out how to get that fiber to the tower, because it just keeps more and more traffic and more use and more dependency on these towers and in this wireless network. But I'm excited about the future. I mean, to sum it up, what Clayton said is we've been through a lot, like COVID and all these things, wars, just all this stuff, and the resiliency of the wireless industry is amazing.
Yeah, and you kind of introduced a couple bullish views before any questions from the audience. I think the obvious, the wireless demand, right? Everybody having multiple devices, et cetera, that's been the driver for the space for years and years and years. I think that'll continue. And then the other part too is figuring out government subsidies for connectivity. There was the hiccup starts with the BEAD deployment, et cetera, but if we've got the government, agreeing on something on both sides of the aisle, and that's that the nation needs more connectivity. I know there's a big focus on fiber, but there's also, I think, an increasing, kind of education going on to show that wireless connectivity through, WISPs, fixed wireless, et cetera, can provide an alternative to fiber that's almost just as good, if not just as good, and at a fraction of the cost. So ultimately, if we can get some of that BEAD money, et cetera, other federal funds more focused on wireless instead of wireline, that's going to be phenomenal for the space going forward. We got a few minutes if there's any questions from the crowd. Hey, John.
Well, let me tell you what keeps me worried, what keeps me up at night. That is the fact that over the past several years, our cost to construct the towers has increased by at least 20%, while the revenue has decreased by about the same amount. So in terms of a worry, I don't know how sustainable that is for the industry, and I don't know what the end game is going to be in terms of carriers' increased loads. We now have some of our 4 carrier towers with the increased carrier load. Now there are only 3 carrier towers. And we're all wondering what the end game is going to be regarding cost of construction and average revenue per tower.
Yeah, I mean, I think that goes back to the carrier health comment that all of us had, right? If the carriers are healthy, if they're able to increase their ARPUs, then they're not necessarily in the cost reduction mindset, to your point, on your revenues or the consolidation. We need higher revenues from the carriers on the ARPU basis so to support our tower rents. The inflation doesn't help on the construction side, but you have to have it on the flip side of the revenue.
Yeah, and I think as tower owners, we have nobody to blame but ourselves.
Yeah, I was going to jump in there real fast too. I mean, I know one of the downsides of all this money coming in is people are agreeing to deals that are not as advantageous to a tower owner as they used to be, right? And I know this is easier said than done, but I think, Todd, you had mentioned it kind of near the end of your talk. There's a certain point where you just have to say no. Tough part is there might be 3 people that say yes, and that's what you're up against. So yeah, we hear the same thing too. And if there's anything.
No, I think you said it. I mean, Liberation Day, right? That didn't help as well, and COVID didn't help as well on the tariff and the duty front. So,
yeah. Any other questions? All right. Well, everybody, thanks for your time, and let's go eat.